Hey everyone, welcome to this week's Stock and Macro Update. So this week I want to talk about Airbnb, which is another company in the 21 Disruptors Index. Then I want to get into a portfolio review for the past week. And then I want to get into the macro side of things and talk about the PMI data that came out last week. So starting off with Airbnb, this is a company that really has shined this year and I think has flown way under the radar. They are a company that has massive growth. They are a huge dominant player in their market, and they're really disrupting the $717 billion travel and tourism industry. So just a couple of quick stats on them. They have a 40% market share of the $32.8 billion alternative accommodation industry. They are right ahead of Booking Holdings in terms of that. But unlike Booking Holdings and unlike a lot of hotel companies, airline companies, and other stocks that you would look at that are really reliant on travel and tourism, Airbnb is way ahead of the place that they were in 2019. So they have 73% sales growth since 2019, or that's what they're on pace to do for 2022. Meanwhile, Booking Holdings has about 10%, 11% growth since then, and a lot of hotels and airlines and other travel companies are still seeing growth or a negative growth since 2019. So Airbnb really separates itself from the competition there. And another thing is the gig economy, I think, is going to be a really resilient and strong part of the economy when it comes to recession, because not only does it, have a really high growth kind of business model, but it also, a lot of people are going to be looking for extra income. And these companies like Uber, Airbnb, and other successful gig economy companies, they started in the midst of the great financial crisis in 2008, and they were able to not only get through those tough times, but also grow a really new startup during those times. And it's because people were looking to, rent out part of their house on Airbnb, or basically operate as a taxi service for Uber during these tough times. So I think that we're going to see a lot of people be surprised at Airbnb's resiliency and strength if it does come to recession within the next quarter or two, which it's looking like it's going to happen within the next year at the very minimum. So financially, Airbnb is also very strong. They've got $3.3 billion worth of positive free cash flow over the past year, and they have $9.62 billion worth of cash versus just about $2 billion worth of debt on their balance sheet, and that cash almost exceeds their total liabilities, which is another great sign. And that's something that we see in quite a bit of these disruptors, is they have really healthy cash, they have positive cash flow, and that is able to sustain their business. Unlike a lot of these companies, though, Airbnb is profitable and they have really rapidly expanding margins as well. So we're seeing growth in every single corner of Airbnb's business, which is definitely great to see during this kind of year where overall growth in earnings, growth in sales is slowing down quite a bit, especially when you compare that to inflation. So just doing a quick performance update on the disruptors. Over the past week, the disruptors index is down about 1.8%, S&P 500 down 0.7%, NASDAQ up about 0.25%, Russell 2000 down about 1.5%, and ARKK up about 0.2%. So it's been another rough week for commodities. Even though the dollar has been down, commodities are still getting crushed. So we have multiple stocks that are really sensitive to commodity prices like lithium, uranium, and rare earth minerals. So we've got that kind of exposure, but with growth, it's also been kind of shaky, very inconsistent kind of returns that we've seen in the portfolio this week. On the bright side, we did see a new high with Enphase. So some of the stocks in our portfolio are still performing really well. And you can't say that many growth stocks these days are making new 52-week highs, so that was really good to see from Enphase. We do have DocuSign earnings coming up tomorrow as well, so make sure you watch out for that in next week's update. So getting to the macro side of things, I wanted to go over leading versus coincident indicators and focus on the PMI, which or the manufacturing PMI, which covers kind of the manufacturing sector and the health of that within the U.S. economy. So I've been covering leading indicators for the past few months because they have been in a distinct downtrend. These are the data that really foreshadow what's to come for the economy. So if leading indicators are getting steadily worse month over month like they have, that's usually a really good tool to predict the coming recession. And if they're getting much better, it's usually right before, or at least 6 to 9 months or so before we see the economy come out of a recession. So over the past 6 months, I think the Conference Board leading economic index is down over 3%, which is a pretty steady rate of decline. And really it's been like that for over a year. Meanwhile, the coincident and lagging indicators have been really strong. So it's only the leading indicators that we're seeing weakness in. But I think that's starting to change now with the PMI, or the manufacturing PMI. The way that the PMI works is when the reading comes in over 50, and this is measured on a monthly basis. When PMI is over 50, it means that part of the economy is expanding. And when it's under 50, it means that part of the economy is contracting. So when manufacturing PMI comes in under 50, it means that the manufacturing sector in the U.S. is contracting. And we just got the first reading under 50 for November. It was 49, so not far under 50, but it broke I believe 29 or 30 month trend of these monthly readings coming in over 50. So it is a sign that the manufacturing part of the economy is actually now in contraction. And there are a lot of things in that report that really point to this, and it actually is pointing to signs of deflation in the goods sector of the economy. So, and that doesn't mean that I think that the CPI is going to be negative anytime soon. Actually, a lot of the CPI depends on services and their arbitrary real estate reading. So those are a lot more sticky, but from a goods point of view in manufacturing, it does look like deflation is going to be here very soon if it's not already here. So we're seeing inventories up sharply, backlogs down sharply. So inventories are rising, and new orders from other companies are waning pretty severely here. And backlogs are basically just future commitments to buy companies' products. So those are down a lot. Imports are down and prices are down. So less ordering from domestic suppliers, less ordering from international suppliers, and prices therefore are coming down because inventories are just building up and there's just not the demand there to meet that inventory at the current prices. So obviously they have to shift prices down in this kind of setup. So a lot of the companies, and this is where I want to highlight the disruptors, a lot of the goods producing companies that we have in the 21 disruptors index are seeing rising backlogs. So I always want to tie any negative news about the economy back to the disruptors, because a lot of the times this is where we see the separation between the old and the new, and how disrupting companies are taking market share and are going to be relatively strong even in a rough economy. So yeah, backlogs for these companies are rising pretty steadily. And as we get into more of these reviews for the disruptors index, and as I've highlighted in prior articles, just when I go over the 21 disruptors one or two at a time every week, if you go back and read, you'll see that I usually highlight backlogs where applicable, and they are rising, meaning that demand is actually growing for these products relative to the rest of the manufacturing and goods part of the economy, where demand is really coming off or falling off a cliff, not only from an endpoint consumer point of view, but also business to business, where suppliers are seeing falling rates of demand or falling demand for their products from the companies that sell us the final goods. So I just wanted to highlight that as well. These disruptors are seeing growth. They are seeing demand for their products in the face of a rough macro backdrop. And so we should continue to see rising sales for these companies. And a lot of them are very solid in terms of cash versus debt and maintaining positive cash flow. So, it's just a matter of time before the market gets the picture here where a lot of the safe haven stuff, or the stuff that people see as safe havens, are really in trouble because they have rising debt in a rising rate kind of market and not enough cash to really sustain that. Plus, they rely on debt for share buybacks and dividends and so forth, whereas that's not the case with really any of our companies. So I just wanted to highlight that. It's not going to be like an overnight process. It just clicks for the market. This is something I think that is going to become more obvious every quarter, as I've said before, as we see more quarterly reports come out for disruptors, and it'll be so easy to tell the difference. It'll be like night and day versus the companies that they're disrupting. It's going to be a slow process that the market figures this out, but it's going to get gradually faster as we go forward. So that is it for this week. I go into more detail of all of those things in the Substack, so make sure you check that out as well. But thank you everybody for watching, and I will see you again on Friday for the crypto update.